clocks fall back at the end of the week on Sunday the 28th of October, but as the mornings and nights draw in, there's more than enough to be keeping investors occupied. On the macroeconomic front, there are two possible headline grabbers. The first is the latest meeting of the European Central Bank on Tuesday the 25th of October. President Mario Draghi is likely to announce that interest rates have been left unchanged at 0%, and that the EU's monetary authority will run its quantitative easing bond buying programme at €15 billion a month until it stops adding to the scheme altogether at the end of December. We can see here the ECB's balance sheet and headline interest rate on a monthly basis over pretty much the past decade. The big question now is, can the Eurozone's economy and stock market stand on their own 2 feet without the ECB's help? That first test may already well be coming in the form of the sell-off in the Italian bond markets on the back of the controversial coalition government budget. The second item, well, that's the third quarter GDP growth number for America on Friday the 26th. Now, I accept this is a backward-looking figure, while stock markets are forward-looking mechanisms that look to discount future events and price them in. But after the mid-October stumble, this number is going to attract a lot of attention whether it should or not, as stock markets try to recapture their poise. Now, it rather feels like markets, bond and equity, have started to lose faith in the Goldilocks scenario, where the US is not too cold to threaten corporate profit growth forecasts, or too hot to provoke sharp increases in interest rates. Instead, they're flipping from worrying about a flattening yield curve and a possible slowdown to whether inflation and whether the Trump tax cuts will provoke overheating and those rapid rises in the Fed funds rate. Now, in the second quarter, the US grew at an annualized rate of 4.2%. For Q3, the Atlanta Fed's GDP Now forecast is looking for 4.2% growth, while the New York Fed Nowcast, that's looking for 2.2%. So let's see which one is closer and what response the actual figure gets. Don't forget, however, that the figure released on the 26th is just an initial estimate. There'll be 2 more revisions to that in the next few weeks. There's also going to be no shortage of interesting news from individual companies either. In America, 170 of America's S&P 500 benchmark will report between the 22nd and the 26th. The 25th is a big day to watch, as that's when major technology companies Amazon, Alphabet, the parent of Google, Microsoft and Intel all report their quarterly numbers. Amazon and Alphabet could be particularly influential as 2 of the so-called FANG stocks, which did so much to take the US and global stock markets to new all-time highs this year. Now, back here in the UK, 11 FTSE 100 firms are due to issue results or trading statements. They include minor Anglo-American and Whitbread on Tuesday the 23rd, another minor Chilean copper giant Antofagasta on the 24th, Lloyds and WPP on the 25th, when we'll also get struggling retailer Debenhams releasing full-year figures, and then we got Glencore, British Airways parent International and Consolidated Airlines, and the Royal Bank of Scotland on Friday the 26th. But for me, the stock most capable of causing a fuss in the week ahead is another bank, Barclays, when it releases its third quarter figures on Wednesday the 24th of October. As we can see from the chart, the stock's performed very poorly in 2018. It'll be of little consolation to shareholders or Barclays Chief Executive Jez Staley and his team that Barclays has not been on its own in this respect. The FTSE All-Share Banks Index is down by a mid-teens percentage for the year so far, and currently ranks just 35th out of the 39 sectors that make up the FTSE All-Share. That in itself could be a worrying sign. If the banks are not doing well, is there something more serious amiss either with the economy or the financial markets plumbing? As such, Barclays' results could be a timely test, especially as Lloyds and RBS also report in the coming week, and HSBC and Standard Chartered in the following one. Analysts will initially focus on the headline pre-tax profit number. In the third quarter a year ago, this came to £1.1 billion, so that's your benchmark for this year. The next graphic shows the quarterly progression over the last 5 years, and as we can see, the patterns are pretty uneven one at best. Analysts and investors will then focus not so much on quantity of figures as the quality of the earnings. The first numbers to check here will be growth in risk-weighted assets and loans. Like many big banks, Barclays has focused on simplifying its business, cutting costs and improving its conduct in the eyes of the regulator. Jez Staley seems more wedded to the investment bank than his predecessor Anthony Jenkins was, and the first half statement did talk of investment initiatives designed to fuel top-line growth across the whole bank, even while trying to keep a close eye on costs. Risk-weighted assets and loans both fell year-on-year in Q2, although the deconsolidation of Barclays Africa had a lot to do with that. Then we need to look at loan loss and impairment charges, restructuring costs, and also litigation and conduct provisions relating to things like protection payment insurance or PPI. The total cost of these items since 2014 to Barclays has been around £26 billion. That compares to pre-tax income over the same period of £11 billion. So if these figures start to drop, then earnings could rise sharply, although the 2019 deadline for PPI claims in the UK means there's always the risk of a fresh chunk of claims and costs at some stage. This next chart shows how loan losses, restructuring and litigation have added up on a quarterly basis, also back to the start of 2014. Finally, watch out for any comment from Mr. Staley on the presence of activist investor Sherborne on the share register. Nothing's come of this yet, but Edward Bramson, Sherborne's boss, is tenacious and has a track record of getting his way and often boosting share price performance in the process. Thank you for watching, and I look forward to seeing you next time.